Master the curriculum with StudyBuddy by Dr. Lei, independent of CFA Institute. Let's go.
Thanks for checking in with us today. You will find all of our conversation tied directly and accurately to the CFA curriculum. I am DigiJames, along with my co-host Dr. Lei's digital twin TalLe. Together, we will help you prepare for the exam thoroughly.
Hi everyone, it's great to have you with us. Today's episode is all about the why behind the markets.
What would happen if you woke up tomorrow and your bank charged you $10 a month just to keep $1,000 in your savings account? The number one reason candidates fail. Capital market expectations isn't the math. It's assuming interest rates have a floor at zero. Here is the logic you need to beat the zero lower bound trap that the CFA Institute loves to set.
James, that scenario is exactly what the curriculum defines as a negative interest rate policy, or NIRP. Historically, economists believed in a zero lower bound because they assumed individuals would rationally choose to hold physical currency, actual coins and notes, rather than accept a negative return on bank deposits. This belief suggested that if rates went negative, everyone would withdraw their cash, draining reserves from the banking system and causing bank balance sheets to shrink. Consequently, this credit contraction would push interest rates back up, effectively defeating the central bank's attempt to provide monetary stimulus.
So, the old school thinking was that cash is like a free storage locker for value. If the bank tries to take a bite out of your cookie, you just take your cookies home, right?
Precisely, but the curriculum explains why that move into currency didn't happen during recent crises. In our modern economy, the sheer scale and speed of transactions, trillions of dollars daily, cannot be supported by physical cash. Bank deposits have a convenience value, which is an implicit yield that physical cash lacks for large-scale trade. As long as this convenience value exceeds the explicit cost of the negative interest rate, there is no incentive for large entities to convert deposits into physical cash.
It's like paying for a parking spot in the city. You hate the fee, but carrying your car in your pocket isn't exactly an option.
That is a perfect analogy for the institutional reality. Furthermore, central banks like the European Central Bank and the Bank of Japan proved that negative policy rates are sustainable. On the exam, if you are asked to justify why NIRP is possible, you must mention that the logistical impossibility of using physical cash for modern trade keeps deposits in the system. You should also note that many banks avoided charging retail customers negative rates, which further mitigated the incentive to hoard physical cash.
So the zero lower bound was more of a zero suggestion. But did this voodoo math actually make the economy grow?
That is the level 3 nuance. The effectiveness of expansionary monetary policy is much more tenuous at negative levels. While theory suggests low rates encourage businesses to invest, the curriculum notes that in a negative rate environment, uncertainty regarding risk compensation increases. If investors and businesses are uncertain, they will be adequately rewarded for taking risks. They may simply refuse to act as the central bank desires. Therefore, expansionary monetary policy becomes less reliable when nominal rates cross below the zero threshold.
It's like trying to push a piece of string. You can push the interest rate down, but you can't force the consumer to actually spend the money.
Exactly, James. The curriculum highlights that while quantitative easing, the large-scale purchase of domestic bonds, lowered sovereign bond yields, it didn't always lead to capital expenditure. Instead of building new factories, many businesses used the cheap borrowed money to fund dividends and stock buybacks. When you are formulating expectations for the exam, you must recognize that the path from lower rates to actual economic growth is often disrupted by these behavioral shifts.
Okay, TalLe, so if I'm an analyst and the world has gone upside down with negative rates, how do I even start my model?
This is a critical point for your forecast. When short-term rates are negative, analysts should use the long-run equilibrium short-term rate as the baseline instead of the observed negative rate. This equilibrium rate is often estimated using the neutral policy rate, the rate that neither stimulates nor slows the economy, adjusted for a modest spread. You essentially look past the current distress rate to see where the natural rate should be once the economy stabilizes.
So don't build your house on the swamp of negative rates. Use the solid ground of the neutral rate as your foundation.
Correct. And remember, the shorter your forecast horizon, the more you must consider deviations from the most likely path. Negative rates often signal severe economic distress, which means historical data becomes less reliable. On the exam, if they ask you why a statistical model might fail in a NIRP environment, you should mention that quantitative models break down when the current environment differs fundamentally from the historical data used to calibrate those models.
If you understood this NIRP breakdown, you're going to need the next segment on the policy mix matrix to pass the morning session. Ever tried to drive a car with one foot in the gas and the other on the brake? That's basically what happens when the government and the central bank aren't on the same page. The number one trap on the exam is confusing how loose fiscal policy fights with tight monetary policy. Here is the logic you need to predict where interest rates are actually headed.
That's a vivid way to put it, James. In the CFA curriculum, we analyze the policy mix, which is the combined effect of fiscal policy, government spending and taxes, and monetary policy, central bank actions like setting interest rates. Fiscal policy is often driven by politics, while central banks strive for independence to maintain credibility. When we look at the average level of rates, we have to distinguish between real interest rates, which are adjusted for inflation, and nominal interest rates, which are the actual numbers you see on a bond.
So if the government is loose, meaning they are spending money like they just won the lottery, and the central bank is tight, meaning they are acting like a strict librarian, who wins the tug of war over my wallet?
In that specific scenario, loose fiscal and tight monetary, the curriculum states we get high real rates. This happens because a loose fiscal policy or a large deficit requires the private sector to save more or attract capital from abroad, which pushes up the real cost of money. However, because the monetary policy is tight, the central bank is successfully fighting inflation. This leads to low expected inflation. When you combine high real rates with low inflation, the nominal rate ends up in the mid-range.
It's like a spicy pepper cooled down by a glass of milk. The real heat is there, but the nominal burn is managed by the central bank's tight milk.
Exactly. Let's look at the opposite. Tight fiscal and loose monetary. Here, the government is being frugal, which leads to low real rates because there's less demand for credit. But the central bank is pumping money into the system, which creates high expected inflation. Again, the nominal rate ends up at a mid-level because the two forces are offsetting. On the exam, if they ask you to determine the impact of a dual loose policy, loose fiscal and loose monetary, the answer is high nominal rates, because both high real rates and high inflation are pushing the number up.
Okay, so double loose is a bonfire for interest rates. What about a double tight policy? Is that like an economic ice age?
Precisely. Tight fiscal and tight monetary leads to low real rates and low expected inflation, resulting in the low nominal rates we often see during a major slowdown. On a Level 3 essay, if you are asked to justify why loose fiscal policy increases real rates, you must explain that the domestic private sector must be induced to save more or invest less to fund the government deficit. If you don't mention that crowding out logic, you'll miss the points.
Got it. Real rates are about the demand for physical cash, and inflation is about the supply of money.
That's a solid mental model. We've just navigated the GPS check of the 4 policy quadrants. We've seen how the average level of rates stays high, low, or in the middle, depending on the mix of government spending and central bank restraint. But the level of rates is only half the story. We also need to know the slope of the curve, which tells us where the cycle is going next.
The slope. That's the part that looks like a roller coaster track, right?
Very much so. The slope, or the term structure, is driven by two things: the expected future path of short-term rates and the maturity premium, the extra return investors demand for the risk of holding a long-term bond. Normally, the curve is upward sloping because of that maturity premium. However, as the business cycle moves from initial recovery to slowdown, the curve's shape shifts dramatically because of how monetary policy reacts to growth. As the business cycle reaches the late expansion phase, the central bank becomes restrictive to prevent overheating, causing short-term rates to rise above their long-term averages. This puts intense upward pressure on the front end of the curve. Meanwhile, the back end stays stable or even drops as investors anticipate a future peak in growth and a cooling economy. This specific mechanical tug-of-war causes the yield curve to flatten significantly. On the exam, if you are asked to justify this flattening, you must mention that the rise in short-term policy rates is outpacing the change in long-term inflation expectations.
So, the curve is like a mood ring for the economy. If it's flat, the economy is feeling a bit squeezed by those high short-term rates, and if it's steep, it's feeling hopeful about a recovery.
Exactly, James. On the exam, if they ask you to justify a flattening curve during an expansion, you must explain that it's driven by the central bank withdrawing stimulus and raising money market rates faster than long-term yields are rising. This brings us to a GPS check. We've seen how the average level of rates is set by the fiscal monetary mix, and now we see how the slope is a direct reaction to where we are in the business cycle.
It's like the slope is the economy's way of shouting, "Hey, I'm getting tired," before it actually falls over into a recession.
That is a perfect analytical bridge. When we see the curve move from flat to inverted, where short rates are actually higher than long rates, it is a classic predictor that a slowdown has arrived and the central bank has reached its tightest point. For the morning session, remember, the curve is steepest at the trough of the cycle and flattest at the peak.
If the yield curve were a person, it would be the most predictable person at a party. When things are looking up, it's all smiles and steep slopes. But when the music stops, it gets flat and grumpy. The number one mistake is thinking the long bond always tells the truth. Here is how the CFA Institute expects you to read the mood ring of the economy so you don't get trapped by a fake signal.
That mood ring analogy is quite apt, James, specifically because the shape of the yield curve is primarily determined by market participants' expectations of future short-term rates and the maturity premium, that extra compensation for the volatility risk of holding longer-dated debt. We move through 4 distinct phases of the business cycle, and the yield curve reacts with almost surgical precision. In the initial recovery, the central bank keeps a stimulative stance, keeping money market rates at their absolute bottom. Consequently, while the shortest yields are pinned down, long rates begin to rise as the market anticipates future growth, making the curve reach its steepest point.
So, at the start of the party, the short-term rates are the cheap snacks at the door, but everyone is eyeing the prime dinner of long-term yields further down the table.
Exactly. As we transition into early expansion, the central bank begins withdrawing that stimulus, and short-term rates start moving up. Because short rates are rising but long rates are relatively stable at the long end, the curve begins its initial flattening. By the time we hit late expansion, the central bank is becoming restrictive, basically trying to take the punch bowl away, and short rates rise above their historical average. Here, the front section of the curve steepens as the central bank hikes, but the back half flattens because investors expect an eventual peak and decline in growth.
It's like a bridge that's starting to sag in the middle because the weight of high interest rates is getting too heavy for the economy to carry.
That sagging leads us to the slowdown phase. This is the most dangerous part for a forecaster. The central bank is at its tightest, pushing short-term rates to their peak. Bond yields also peak and then may decline sharply as investors scramble for the safety of duration, causing the yield curve to become flat or even inverted, where short-term rates are actually higher than long-term yields. On the exam, if they ask you to interpret an inverted curve, you must justify it by stating that it reflects an expectation of future economic contraction and a subsequent decline in policy rates.
And then the crash, the contraction, the part where everyone realizes they stayed too late and the central bank starts throwing life vests into the water.
In the contraction, the central bank becomes progressively more stimulative to counteract downward momentum, causing short-term rates to decline rapidly. Long-term yields also decline, but the curve starts steepening again because the shortest rates fall much faster than the long rates. This brings us back to our GPS check. We've gone from steep recovery to flattening expansion to inverted slowdown and back to steepening contraction. If you're asked to project bond yields after a deflationary shock, remember that the curve will likely reach its steepest point right at the trough of the policy cycle.
So if I see the curve steepening while the economy is still in the gutter, that's actually a buy signal for the next recovery?
Precisely, because it signals that the central bank's medicine is starting to work, even if the patient doesn't feel better yet. However, stay sharp. The curriculum notes that if a government has massive debt, they might coerce the central bank into inflating it away with forever low rates. This risk of politicization will almost certainly steepen the yield curve even further, because investors will demand a massive inflation premium to hold long-term bonds.
If you understood this cycle of slopes, you're going to need the next segment on international linkages to pass the morning session. Imagine you're at a global trade party. One friend is selling homemade cookies but buying everyone else's craft beer. To pay for it, they have to start selling off their furniture or taking out IOUs from the neighbors. This is exactly how countries balance their books. The number one trap on the exam is forgetting that the current account and the capital account are like a mirror. If one goes into a hole, the other must climb a mountain.
That is the fundamental identity of international macroeconomics, James. In the CFA curriculum, we define the current account as the record of net exports of goods and services plus net investment income and transfers. The capital account, which also includes the financial account for our purposes, records the net flow of investment for things like building factories, known as foreign direct investment, FDI, and buying stocks or bonds, known as portfolio investment, PI. By construction, if a country has a surplus on the current account, it must have a matching deficit on the capital account, and vice versa.
So, if I'm an American buying a German car, that's a current account minus for me, but it means I have to send some capital back to Germany to pay for it.
Precisely. National income accounting gives us a powerful formula. Net exports X minus M equals net private saving S minus I plus the government surplus T minus G. In plain English, if a country's people aren't saving enough and the government is running a deficit, that country must run a current account deficit. To fund that deficit, they have to attract capital from abroad, essentially borrowing from the rest of the world or selling off domestic assets.
It's like a level 3 secret. You can't just look at trade in isolation. You have to look at the saving habits of the people and the spending habits of the government.
Exactly, James. Let's look at a trap scenario. Suppose a large country like the US passes a massive business tax cut but doesn't cut spending. This increases the government deficit. All else being equal, this increases the current account deficit, 1-for-1. If the tax cut works and businesses start building more factories, increasing domestic investment, the current account deficit actually gets wider because more capital is needed than the country is saving.
So, A good thing, like more investment, can actually make the trade gap look worse.
Correct, James. On the exam, if they ask you to justify why a tax cut increases the capital account surplus, you must explain that the country needs to attract additional capital flows from abroad to fund the increased deficit and investment. This usually leads to rising equity values as investors chase after tax profits and may require domestic interest rates and bond yields to rise relative to the rest of the world to attract that foreign cash.
It's like a magnet. To get the neighbor's money to come to your yard, you have to offer them a better interest rate snack.
That's a great way to see the mechanics. We've just completed a GPS check. We know that current and capital accounts must offset. We've seen how government deficits and private investment drive the need for foreign capital. But there's a catch. Moving that money across borders involves exchange rates, and that's where the impossible trinity comes in.
The impossible trinity sounds like a high-stakes poker game where someone is definitely bluffing.
It is. It's the rule that a country can't have it all. They can't have free capital flows, a fixed exchange rate, and an independent monetary policy all at once. If you understood this balancing act, you're going to need the next segment on interest rate and exchange rate linkages to see how the house of cards stays standing. James, your witty analogy is needed here.
Of course. Imagine you're at a carnival and there's a game with 3 levers, but the sign says you can only pull 2. If you pull all 3, the whole machine explodes. This is the impossible trinity, and it's how central banks decide if they're going to be a lone wolf or part of the pack. The number 1 trap is thinking a pegged currency means the interest rates must be identical. Here is the nuance you need to avoid the fixed rate trap.
That carnival game is a perfect metaphor for the trilemma, James. The curriculum is very specific. A country cannot simultaneously allow unrestricted capital flows, maintain a fixed exchange rate, and pursue an independent monetary policy. If capital can move freely and you want a fixed exchange rate, you lose control of your interest rates. If you try to push your rates down to help your own economy, capital will immediately flow out to find higher yields elsewhere, putting downward pressure on your currency. To keep the rate fixed, the central bank would have to buy its own currency, which effectively reverses that expansionary policy you just tried to start.
So, it's like trying to keep a balloon underwater. You can push it down with your independent policy hand, but the capital flow water just pushes it right back up to the fixed rate surface.
Exactly. This leads to a major level 3 secret. Under what conditions would 2 different markets share the exact same yield curve? For a complete convergence, you need 2 things. First, unrestricted capital mobility, so risk-adjusted returns are equalized. Second, and this is the hard part, the exchange rate must be credibly fixed forever. Investors must believe there is zero risk of a future devaluation. If there is even a sliver of doubt, yield differentials will emerge because investors will demand a risk premium to stay in the potentially weaker currency.
Credibly fixed forever sounds like a long time, TalLe. Even the Eurozone countries have different rates, right? I thought they were all on the same team.
You hit the nail on the head. Even in the Eurozone, where separate currencies no longer exist, countries like Greece, Italy, and Spain have almost always traded at varying spreads over Germany and France. This happens because the market perceives an imminent threat of devaluation or even a withdrawal from the common currency. When a Brexit-style crisis hits, spreads don't just widen. The yield curve in the weaker country will almost certainly invert.
Wait, it inverts? Why would investors want the long-term stuff if the country's about to leave the club?
It's a bit counterintuitive, but follow the logic. If a devaluation happens, yields in the devaluing currency will eventually decline sharply as the currency risk premium collapses. This generates massive capital gains on longer-term bonds, which helps mitigate the loss you took on the currency itself. On the exam, if they ask you to justify why a curve inverts during a currency crisis, you must mention that long maturity yields incorporate the expectation of future gains that offset the currency loss.
So the long bond becomes a hedge for the currency fire. That's a deep-cut strategy right there.
It is. And for our GPS check, we've seen how the Trinity forces a choice between independence and stability. We've seen that even fixed rates aren't truly fixed if the market smells a devaluation. This expectation is what links everything together. If you're forecasting for a country with a floating rate, remember interest rates must generally be higher in a currency that is expected to depreciate to equalize the total return for investors.
It's like a bad currency has to offer a good coupon just to get people to show up to the party.
Precisely. If you understood the Trinity and the convergence trap, you're going to need the next segment on real yield linkages to see how global savings actually move the needle.
So, TalLe, we've talked about currencies being like a bad coupon, but what about the actual real growth? If I'm a global investor, do I just move my money to wherever the grass looks greenest, or is there a global lawnmower that keeps everything the same height?
That's a sophisticated question, James. The curriculum distinguishes between the financial market perspective and the real economy. From an investor's view, what matters is the real return they earn in their own domestic currency. Even if non-domestic interest rates are high, the real return won't equal the foreign real interest rate unless purchasing power parity, PPP, holds over the investment horizon. Empirical evidence shows that PPP usually fails over relevant investment horizons, meaning we can't simply assume that real interest rate differentials are easy arbitrage opportunities.
So, just because a country has a higher real rate, it doesn't mean I'm automatically going to get rich by moving my money there. There's no easy button.
Exactly. However, and let's seek for the secret for this part. Real interest rates must ultimately be consistent with the saving and investment decisions that drive economic growth and capital productivity. There is essentially a global market for capital. Excess saving in one country, like the high levels seen in Asia, funds excess investment in another, like the United States. Because global savings must always equal global investment, real rates across the world tend to move together over time.
It's like a giant connected swimming pool. If 1,000 people jump into the Asia end of the pool, saving more, the water level, the interest rate, goes up, or in this case, down, for everyone in the US end too.
That is a perfect analogy for the global savings glut. On the exam, if they ask you to justify why real yields are correlated globally, you must mention that the requirement for global savings to equal global investment forces these rates to move in tandem. While they don't have to be exactly equal, they are linked through the current accounts of each nation.
So the global lawnmower is actually just the fact that money is liquid and looking for the most productive home.
Precisely. For our GPS check, we've learned that nominal rates are linked by exchange rate expectations, while real rates are linked by the global balance of savings and investment. But what happens when the government starts messing with the supply of the bonds themselves?
The supply side drama. Is that like when a concert releases more tickets and the scalper prices crash?
Very similar. If you understood how the global pool of savings sets the baseline, you're going to need the next segment on maturity management to see how central bank shopping sprees change the shape of the curve. James, please give us a vivid situation to start.
Definitely. So imagine the government is putting on a massive concert, but they haven't decided if they're selling 3-month passes or 30-year front row seats. The number one reason candidates get confused by maturity management is thinking that just changing the amount of debt outstanding changes the long-term price forever. Here is the logic you need to see through the central bank's smoke and mirrors.
That is a very pertinent debate in the curriculum, James. Maturity management refers to how the government chooses to fund its deficits and how the central bank manages the maturity of its own massive bond holdings. If the government issues more long-term bonds, does that push long-term yields up permanently? The evidence suggests that while a sufficiently large flow of supply, the act of selling can move the needle while it's happening. Discrete changes in the total quantity of a specific maturity outstanding rarely have a lasting impact.
It's like a flash sale at a department store. While the sale is on, the yield, or price, changes because everyone is rushing the doors. But once the sale ends, the price goes right back to where the market thinks it should be.
Exactly. This is because government bonds are incredibly liquid. Investors can and do move up and down the yield curve to exploit even tiny yield differentials. If 10-year yields get too high just because the government issued a few more, investors from the 5-year or 30-year space will swoop in to buy them, smoothing out that kink in the curve. However, there is one major exception to this rule: the liability-driven investor trap.
Oh, the pension fund guys. They aren't looking for a quick flip. They need those 30-year bonds like they need oxygen, right?
Precisely. Pension funds and insurance companies have very long-dated liabilities, meaning they must hold very long maturity assets to match them. If the government severely limits the supply of 30-year or 50-year bonds, these entities will keep bidding for them no matter how low the yield goes. The curriculum explicitly mentions the UK yield curve as a case where low yields at the very long end were caused by this scarcity for pension funds.
So, if you're a must-have buyer, you'll pay any price, which means the lawnmower can't reach those super long yields if the supply's choked off.
That's the nuance. On the exam, if they ask you to justify why a specific section of the curve isn't moving with the rest of the market, look for a supply-demand imbalance, specifically involving long-dated liabilities. We've hit our GPS check. We know that for most of the curve, liquidity keeps things balanced, but at the very long end, specialized demand can distort reality.
And if the government keeps running these huge deficits and the central bank keeps buying them up, don't we eventually hit a breaking point?
That is exactly where we are headed next, the risk of the inflationary spiral. If you understood why the supply of bonds usually doesn't change the curve forever, you're going to need the next segment on central bank independence to see what happens when the government forces the bank's hand. James, I need your help to introduce the danger of printing the debt away.
Here it comes. Imagine you're at a dinner with your boss, who also happens to be your landlord. They want to give you a raise in monopoly money, but then immediately double your rent. That's the awkward relationship between a government and a central bank. The number one mistake candidates make is assuming central banks are 100% independent forever. Here is the secret to spotting when the independence mask is about to slip.
That is a critical risk factor in Level 3, James. While most central banks strive to appear independent to maintain their credibility, they ultimately derive their power from the government. When a nation's debt levels are high relative to its GDP and rising due to massive fiscal deficits, we enter the politicization danger zone. The government might coerce the central bank into inflating away the real value of that debt through very accommodative monetary policy.
So, instead of making the hard choice to cut spending or raise taxes, the government just asks the bank to print more vouchers until the debt doesn't feel so heavy?
Exactly. This is the inflationary spiral trap. If the market even suspects this is happening, the yield curve will almost certainly steepen immediately as investors demand a higher premium for future inflation risk. If it actually occurs, it creates a feedback loop. Higher inflation leads to higher nominal rates, which makes the debt accumulate even faster, which then requires even more accommodative policy to keep the government solvent.
It's like a dog chasing its own tail, but the tail is made of fire. The faster it runs, the hotter it gets.
Precisely. On the exam, if they ask you to justify why a high debt to GDP ratio leads to a steeper yield curve, you must mention the risk of central bank coercion and the resulting inflationary expectations. This isn't just theory, it's a fundamental part of the capital market expectations framework for countries under fiscal stress.
So, for our GPS check, we've moved from the technical how-to of bond supply to the why of political pressure. We've seen how the curve reacts when the central bank loses its backbone.
Correct. And that leads us to the final piece of the puzzle, the endogeneity problem. We often say the yield curve predicts growth, but what if growth is also predicting the yield curve?
It's a chicken or the egg situation. If you understood how politics can set the curve on fire, you're going to need the next segment on endogeneity and model reliability to ensure your forecasts don't collapse.